The market is a bit under the weather, but bouncing back from the day's lows. Let's do one thing. Let us talk a little bit about the markets and what you should be doing in a situation like this. Varun Lohchab, the head of institutional research at HDFC Securities, now joins us on the phone line. They have a call from HDFC Securities that they believe that there are a couple of pockets which could do well. The domestic market could see some growth, and infrastructure development and manufacturing-led growth is the only sustainable model. So let's get Varun in on this. Varun, hi, good afternoon. I want to talk a little bit about your view because, a lot of the infrastructure companies and manufacturing companies for that matter, whether it's cement, whether it's autos, has indicated to us that things are not as bad as what they feared. And there is a bit of comeback trade here. Green shoots are visible in terms of demand. But my question to you is this. Do you fear that there could perhaps be a second wave, across the globe, which could even hit sentiment in our own markets, thereby taking these stocks lower? And how do you approach this space as a whole?
Yeah, so I think that in near term, the markets were playing the unlock trade over last 2 to 3 weeks. And, I would not read too much into the, first month numbers because it's going to be all over the place. The inventory pipeline filling might be there, so numbers might look optically better, plus the pent-up demand. So I think barring the near-term numbers aside, I think from a 12-month perspective, we are slightly cautious on the markets at current levels. We have been advocating a broad range of 8,500 to 10,000 on Nifty. And we see very limited sort of upsides beyond 10,000 given the current global situation and how COVID is panning out in India. And even, pre-COVID, India's, economic growth wasn't very strong. So I think from a 12-month perspective, we would be slightly cautious on the markets. At the same time, some of these sectors like chemicals, cement, capital goods, infrastructure to a select extent, the stronger names. We do have some of them in our model portfolio, apart from the defensives like telecom, IT, and pharma, whereas we are underweight on consumption. So that's a broad sort of a market view from a 12-month perspective.
Okay, I wanted to talk a little bit in detail about cement because in the last 2 days we had two players, Heidelberg Cement and Sri Digvijay Cement, telling us that things have improved, especially in the rural markets. Demand has picked up and, they're expecting growth going ahead. What are the cement stocks that you recommend one should buy? Are you looking at names like Sri Cement, Heidelberg, India Cement, or anything else from the, say, broader markets that you like?
Yeah, so from our coverage, we have had, Ultratech Cement and JK Cement in our model portfolio. Those are, preferred by our analysts as well. I think the results of cement names was quite good for Q4. They are also benefiting from lower input costs, so EBITDA per tons trended very good. The channel checks for May were again a positive surprise with, volumes almost back to 80% of normal as per our channel checks, which is quite good. But again, would not read too much into just May numbers because we are just about to enter into monsoon, so there might be a lot of unfinished work which might be getting over. So clear demand trends will only emerge in the second half, but it's a sector which has strong balance sheets, good profitability and benefiting from lower input prices. The demand destruction is not going to be as severe as I think what the stock prices were reflecting a couple of months back. So therefore we have been constructive on on cement space, and it would remain that way despite the stocks have had a good run up. Even ACC is liked by our analysts. So we have quite a few buy names in cement.
Okay, all right. As you said, good recovery, Varun, we have seen in May after, shutdown in April. But second half of the year is going to be even more crucial in terms of demand trends and pricing trends. Let's turn our attention to the pharma space. There seems to be a consensus trade out there. Buy pharma. Are you in that camp?
Not to the extent that I think the market is bullish. So near term, we only have a slight overweight in pharma after the sharp run-up which we have seen. So in our model portfolio, it's not that we are running a very big overweight in pharma. But we believe it's a sector which would benefit from a multi-year trend which is possible in terms of India gaining further market share in the global supply chains, plus domestic demand has anyway been fairly steady for these products. And the exports, the headwinds which were there in US market seem to be coming to an end. So from a 2-3 year perspective, we believe it's a sector where one should be positively inclined, a bit like specialty chemicals. But, given a very sharp rally and where valuations are right now, I think 12-month time frame, absolute upside, it's not a basket case. We have select stocks where we are still positive in pharma, like Cipla, Aurobindo. We have these in our top picks, but I would not go significantly overweight in pharma at this juncture.
About autos, we have a couple of numbers we're expecting today, Mahindra & Mahindra and Eicher Motors. How are valuations look out there? Would you be looking to get into some of these names, or will you be fairly cautious?
So autos, we have been running underweight on the sector. We had Bajaj, our analyst also likes, Hero and Maruti, which are the top picks at this juncture. But we believe, again, the unlock trade has been played in some of those names. And clearly in March, April, some of these were at very attractive valuations given very strong balance sheets. But post 40-50% rally, we believe, I would not rush in to buy auto names at this juncture. Some of the other sectors which we talked about are slightly more preferred. But within, say, overall consumption basket, whereas staples and discretionary, we are more underweight compared to autos. So autos, I think the valuation is starting to get in your favor, which is a good thing. So on every decline, we would be looking to add some of the auto names. But after this sharp rally, would not buy into it, because we believe entire FY21, after, say, the initial pent-up demand, which might be there for lower-end vehicles, we don't see significant traction coming in for big-ticket purchases like automobiles.
Okay. The other space I wanted to check with you, and I see that you have Voltas on your list. So in consumer durables, does it make sense to put more money to work here, whether it's in names like, say, Voltas, Whirlpool, Bajaj Electricals? Because, people are now trying to make their home life simpler, easier, more sales of food processors, fans, ACs, kitchen appliances. So what are the top picks here?
Yeah, so I think consumer durables looks good to us. Valuations have corrected for a lot of these names. I think near-term headwinds are there, especially for summer-centric, companies where, the volumes were lost to an extent. But if I take a 2-3 year view, I think consumer durables, where we are in the penetration story, look better placed than big-ticket automobile items. Consumers would be going out much more to buy these over and above automobiles. And valuations have come off in these. So Voltas, Havells, even Crompton Consumer, these are the top picks from our coverage, in the consumer durable space.
Okay, all right. Thanks a lot for joining us, Varun, and thanks for discussing many individual names. I'm sure it's going to benefit our viewers quite a bit. So those are the stocks that you need to be bullish on over the next few